Okay, on the last video, I had read this question, but I hadn't got to the answer. So I'll read it and then show you the answer. I won't give the commentary I gave down here on the last video, but we'll look at the answer. But just to remind you, because this is only a few minutes later for me, but this may be a different day by the time you're looking at one video to the next one. So TransUnion Corporation issued 5,000 shares for $50 per share in the current year, and it issued 10,000 shares for $37 per share in the following year. And the year after that, the company reacquired 20,000 shares of its own stock for $45 per share. Determine the impact, increase, decrease, or no change of each of these transactions on the following. And I explained that in the last video. Let's go look at their answer. So the first transaction, we sold 5,000 shares for $50 each. So that brought in cash of $250,000, $250,000 increase in total assets, and a $250,000 increase in total stockholders' equity. Notice what I told you on the last video, that total liabilities and net income are not affected by any of these transactions. And remember what we said at the beginning of the discussion on stockholders' equity, and that is that stockholders' equity transactions do not affect income statement accounts. They only affect the balance sheet. Okay. Second transaction, we sold some more shares, 10,000 for $37 per share. $370,000 cash came in, increase in cash, and $370,000 increase in total stockholders' equity. Third transaction, we purchased 20,000 treasury shares. So we purchased those for $45 per share. So 20,000 shares times $45 per share means we paid out $900,000 cash, which decreased total assets, and that increased treasury stock, which is a contra stockholders equity account. So that decreased total stockholders equity by the $900,000. Okay. Now we are going to do exercise 11.8. These are mini exercises. Next. So there we will get the answer up there. And then we'll go back and read the question. So exercise 11.8. Right down here. So the following selected transactions occurred for Corner Corporation. They purchased on February 1st, purchased 400 shares of the company's own stock, so purchased treasury stock, $20 cash per share. The stock is now held in the treasury. That's why it's called treasury stock. So $20 times 400 shares would be $8,000. July 15th, we issued 100 of the shares purchased on February 1st for $30 cash per share. So we are going to credit treasury stock for 100 shares at $20, which was the purchase price. And we're going to debit cash, the amount of cash received, $30 a share times 100 shares, $3,000. Credit treasury stock at $20 per share and credit additional paid-in capital for the rest. Then on September 1st, we issued 60 more shares, this time at less than we paid for it, $15 per share. So in that case, we're going to debit cash for $15 per share times 60 shares. That would be $900, I believe. And we're going to credit treasury stock at cost, $60 per share times 20 or 60 shares times $20 per share. So that's 1,200 or $1,200. And so the $300 difference is going to be a debit to or a reduction of additional paid-in capital. So show the effects of each transaction on the accounting equation, give the journal entries. What impact does the purchase of treasury stock have on dividends paid? Well, the answer is we do not pay dividends on treasury stock. So treasury stock reduces the amount of dividends paid in the case a dividend is declared. Dividends are only paid on outstanding shares, not on issued shares that are in the treasury. And what impact does the reissuance of treasury stock for a higher amount than the purchase price have on net income? The answer is no effect. So let's go look at that solution. So here we have requirement 1, which is, got to go back and look at that. I think it was the accounting equation effects. Yeah, show the effects of each transaction on the accounting equation. So here we have the first one, we purchased treasury stock for cash. So we reduced cash because we paid cash out, reduced stockholders' equity through an increase in treasury stock, which is a contra stockholders' equity account. And the journal entries right down here, debit treasury stock, credit cash for the purchase of that treasury stock. July 15th, we reissued some of those treasury shares. We sold some of them for $3,000. We had paid $2,000 for them. So we're going to increase cash by $3,000. We're going to increase stockholders' equity by $3,000. We do that by reducing treasury stock, which is a contra stockholders' equity account, with a credit. So that's a credit to reduce treasury stock, which carries a debit balance, but increases stockholders' equity. And then we increase additional paid-in capital. So there's our journal entry, debit cash, credit treasury stock at cost, and credit additional paid-in capital for the additional amount that was paid above cost by the people who bought the treasury stock. Okay, September 1st, we reissued some more treasury stock. So we increased cash for the amount of cash received. We decrease treasury stock, which increases stockholders' equity at cost, $20 per share. And then remember, we paid $20 per share when we reacquired it. We sold it for $15 a share. So that $5 a share is going to reduce additional paid-in capital, which reduces stockholders' equity. There's the journal entry, debit cash for the amount of cash received, credit treasury stock at cost, and debit additional paid-in capital, in this case, for the difference, which is less than what we had paid for the treasury stock. Notice no gain or loss involved in either of these transactions. Okay, requirement 3, dividends are not paid on treasury stock. I told you that a few minutes ago. Therefore, the total amount of cash dividends paid is reduced when treasury stock is purchased. That's true. And number 4, the reissuance of treasury stock for more or less than its original repurchase cost does not affect net income. Transaction affects only balance sheet accounts. Okay, let's go back to the textbook and move on then. So, cash dividends on common stock. We've already talked about that. Dividends can take 2 forms. I'm sorry. Here they're talking about the investor's return on their investment comes in 2 ways. One is dividends. The other is an increase in the stock price. And it's nice when you get both of those. Now, when can you declare dividends? And the answer is you need two things. Number one, you need retained earnings because you declare dividends out of retained earnings. So you must have sufficient retained earnings. And then the other thing is if you're going to pay a cash dividend, you need cash to pay it. So you need sufficient cash. Now, there are some dates that are important in dividend declaration. The first is the declaration date. That's the date that the board of directors votes to issue a dividend, and that's called the declaration date. So whatever date the stockholder or the board of directors is meeting and votes to pay a dividend, that is the declaration date. Okay, and then on the declaration date, we do have a journal entry because dividends at that point become a legal obligation. Once they are declared, they become a legal obligation, a liability. They are not an expense. Remember, they are a distribution of profits, not a factor in determining profits. So on the declaration date, we make an entry of debiting dividends, which is a contra owner's equity account, and crediting a liability, dividends payable. Okay. Second date is the record date. So when the board of directors declares a dividend, let's say they do it today, and the day I'm recording this is April 24th, 2020. So their declaration would go something like this. Today we are declaring, let's say, a $1 per share dividend payable to stockholders of record. So that's the record date. Stockholders of record on April 30th, 2020. So April 30th would be the record date. Payable on May 31st. That becomes the date of payment. Okay? Now, on the declaration date, we record this journal entry. Debit dividends, credit dividends payable, because the dividends are now a legal obligation. On the record date, there's no journal entry that's made, but we do make note in our records who the stockholders are showing to be on that date, because on that, whoever we are showing in our records owns the stock at the end of business on the date of record, in our case April 30th, will receive the dividend. Now, what if the stock sold earlier in the day and it just hadn't been recorded? That's tough for the new owners. The old owners get the dividend because they were the owners of record. Now, the payment date is the date that we will pay the dividend, in our case, May 31st. So on May 31st, we will pay the dividend to the owners. On that date, we will debit dividends payable and credit cash. Okay, now there's one other date, and that's the ex-dividend date, and that's the date when the stock begins to trade without the dividend. So if our record date is April 30th, maybe on April 28th, at the end of business, whoever owns that stock on that date is going to get the dividend, because it'll take a couple of days to transfer ownership. So the 29th becomes the ex-dividend date, the date the stock trades without the dividend. Now my time's about to run out. I'll start the next video with a discussion about the ex-dividend date.